So let's move into talking about accounting for receivables. Specifically, accounts receivable. We know that accounts receivable stems from companies allowing their customers to buy now and pay later. Um, so this is what we call our credit sales to customers, and most of these accounts receivables are going to be collected within 30 days. Now, companies that sell on credit expect that some customers may not actually pay what they promised to pay. So because of this, companies don't expect to collect the full amount or the face value of their accounts receivables. Because even carefully screened credit customers sometimes just don't pay their bills. So because of this, we have to record accounts receivables on the balance sheet at what's called the net realizable value, which is simply the amount of accounts receivable minus any allowance for doubtful account. And all this allowance for doubtful account is the company's estimate of the amount of uncollectible accounts receivables. This is going to be considered a contra asset account um, because it reduces the amount of the accounts receivable account to arrive at, like we just discussed, the net realizable value of accounts receivable on the balance sheet. You may hear allowance for doubtful accounts also be referred to as the uncollectible accounts or the bad debt accounts or just bad debts. So GAAP requires the use of the allowance method, which is simply stating that financial statements or which simply states that accounts receivable on the financial statements must be reflected at the net realizable value. When using the allowance method, the bad debts have to be estimated. And once that amount is estimated, then an adjusting entry has to be recorded, which is called the bad debt expense. Now, the bad debt expense is going to be the expense related to the uncollectible accounts, and it's going to be an increase to the doubtful account expense or bad debt expense, and also an increase to the allowance for doubtful accounts. Now, when we estimate uncollectible amounts, there are a few different methods we can use. The first of which is the percent of revenue method or the percent of sales method, and it can also be referred to as the income statement approach. Now, when using this method, the bad debt expense can be calculated by taking the current period sales revenue times the percentage of bad debt. And when we refer to the current period sales revenue, we're only wanting to look at the credit sales unless the question specifically asks to use total sales. Now we want to look at specifically credit sales because total sales can be both cash sales and credit sales. And this bad debt expense is related to credit sales because we're looking at the amount of accounts receivables. Example here we have Allen's Tutoring Service, ATS, a small company providing tutoring services to college students starting operations on January 1, year 1. During year 1, ATS had the following 3 types of events. And the question wants us to use the horizontal financial statements model to show how each event affects the balance sheet, income statement, and statement of cash flows. So first, we have ATS recognizing $3,750 of service revenue earned on account. So that is going to be an increase to our retained earnings for the revenue amount. It's also going to increase this column I have here, net realizable value of accounts receivable. Because we have to show this amount on the balance sheet, I want to go ahead and show in one column the effects and changes to accounts receivable. So we'll call it the net realizable value of accounts receivable. So because there was accounts receivable increase, the net realizable value of accounts receivable is going to increase. Now let's move to the income statement. This amount, like I said, is revenue. So we're going to show an increase to revenue, which in turn increases net income. Now there is no effect on the statement of cash flows because we did not receive any cash. This is revenue received on account. So moving on to number 2, we have ATS collecting $2,750 cash from its accounts receivable in year 1. So cash is increasing by $2,750. And we are collecting this off of our accounts receivable, so that is decreasing the accounts receivable or the net realizable value of accounts receivable. Now, neither revenue or expense is recognized here because this is just a cash collection on a previous sale. Because cash is collected, the statement of cash flows will be increased. And this was in relation to some service revenue received on account. So we're going to call it operating activity. Number 3, we have ATS recognizing uncollectible accounts expense for the uncollectible accounts in the future using the percentage of sales method. The company uses the percentage of revenue method or sales method and estimates that 2% of credit sales are uncollectible. So again, our bad debt expense should be calculated based on current period sales revenue times the bad debt percentage. So this period's credit sales were $37.50. The bad debt expense is 2%. So if we multiply those two, we get a bad debt expense of $75. So when we record a bad debt expense, 2 things happen. Remember, first, the bad debt expense increases. So this expense is going to be a decrease to retained earnings. And then also the allowance for doubtful account increases, which decreases the net realizable value of accounts receivable. Let's move on to the income statement. As we said, this was considered a bad debt expense, so expenses are increasing, which decrease net income. And then lastly, there was no cash received in this transaction. We were just recording the adjusting entry for the bad debt expense. So there's no effect on the statement of cash flows.